Wealth is not an accident of fate. It is a deliberate construct. He who relies on luck perishes. He who applies strategy commands his own future. Data proves 79% of millionaires did not inherit thrones. They built their sovereignty from zero, with tactical discipline and long-term vision. A high salary guarantees no immunity against ruin. Without control, high earnings only finance a faster and more luxurious destruction. In the personal economy, there are two battlefronts: the offensive of earning and the defensive of spending. Victory requires absolute command of both. Time is the scarcest and most valuable resource. Investing early is planting a forest. Investing late is trying to buy shade, paying the price of gold. Compound interest is a neutral and relentless force. For the debtor, they are iron chains. For the investor, they are loyal servants working without pause. The 50-30-20 rule is not merely a suggestion. It is a code of conduct for survival and expansion. Half to live, the rest to conquer. It is crucial to distinguish saving from investing. Saving is stocking provisions that time corrodes. Investing is sowing to harvest an army of new resources. Dependence on a single source of income is a primary strategic error. Real stability requires multiple flows to withstand any crisis. The path to financial freedom with few resources requires cunning. What follows details the precise maneuver to transform scarcity into empire. Rational analysis demonstrates that cash flow is the true indicator of power. Society values gross salary, but the strategist looks at net retention. A man who earns much and spends all is as vulnerable as one who earns little. Wealth is not measured by what enters the coffers, but by what remains in them. Without the capacity to retain capital, any salary increase is futile, for lifestyle inflates to consume the surplus, keeping the individual in perpetual servitude. The time factor acts as a force multiplier. An 18-year-old youth investing a modest amount monthly will accumulate at the end of his career a patrimony superior to that of a 50-year-old veteran trying to compensate for the delay with large contributions. The math is cold. Time rewards anticipation and punishes hesitation. Starting now, even with little, is more efficient than waiting to start big in the future. Inertia is the greatest enemy of capital accumulation. Projections based on average market returns, like the S&P 500, indicate that consistency beats intensity. The regularity of contributions, added to an average profitability of 7% to 10% a year, creates an exponential growth curve. Machiavellian intelligence here lies not in seeking the lucky strike or the risky bet, but in trusting the mathematical inevitability of compound interest. Financial victory is a war of attrition, won by disciplined persistence, not by isolated heroic acts. In the defense of patrimony, expense control is the first line of combat. Small financial leaks, such as unused subscriptions and hidden fees, drain economic strength silently. Constant auditing of personal accounts is necessary to staunch these hemorrhages. It is not about ascetic deprivation, but allocative efficiency. Every resource wasted on something that yields no return or real satisfaction is a soldier lost before the battle has even begun. High-interest consumer debt represents voluntary submission to a predatory system. Paying exorbitant rates on credit cards is transferring one's own wealth to another's vault. The financial strategist uses credit as a leverage or convenience tool, never as a crutch for an unsustainable standard of living. The elimination of these debts is priority zero. There is no way to build a solid empire upon a foundation that charges compound tributes against the builder. Moving to the offensive, income expansion is imperative. Cost reduction has a mathematical limit, zero, but the capacity to generate revenue is theoretically infinite. Settling for a low salary is accepting stagnation. Cunning requires the active search for new sources of gold, whether through promotions, side businesses, or investments. Austerity guarantees the defense, but only the increase of the attack through more income guarantees the conquest of new financial territories. Resource allocation must follow military rigidity. Allocating 50% for basic needs imposes a realistic limit on the standard of living. If survival costs exceed this mark, the individual lives above their real capacity and is exposed to risk. The strategic humility of reducing the standard of living temporarily is the price to pay for future security. Deceiving oneself about one's own accounts is the fastest way to walk toward financial ruin. The 30% destined for desires serve as a necessary escape valve for human nature. Pleasure and leisure keep morale high for the long journey of accumulation. However, the common error is allowing desires to invade the territory of investments. The strategist defines clear limits. Luxury is permitted but must be contained within its budgetary borders. Unbridled desire is a tyrant that, if uncontrolled, devours both the present and the future. The secret of ascension lies in the final 20%. This capital must not merely be saved, but mobilized. The distinction is vital. Idle money loses value to inflation. Invested money works. These 20% are the seed of freedom. Consuming them in depreciable goods is eating the seeds of the next harvest. This amount must be treated as untouchable and sacred, destined exclusively for the acquisition of assets that generate passive cash flow and patrimonial appreciation. Building wealth merely by saving part of a minimum salary is a Herculean and slow task. To accelerate the process, creating an extra income is the ideal tactical maneuver. One should not view extra work as a burden, but as a time accelerator. All capital generated in this parallel activity must be fully invested. This creates an express lane to wealth, allowing decades of accumulation to be compressed into a few years of concentrated effort. The impact of investing 100% of extra income is devastatingly positive. If an individual maintains their cost of living with the main salary and invests everything earned outside, they break the linearity of growth. In 15 years, the return on this parallel effort can exceed the income from the main job. It is the practical application of personal leverage. The majority exchange time for money to spend. Intelligence lies in exchanging time for money to buy perpetual freedom. Complaints about lack of time or fatigue are irrelevant in the face of the need for survival and progress. If the market pays little for the current hour of work, it indicates that the skill offered is common. To increase the value of the hour, one must increase the rarity and utility of the competence. The world pays not for effort, but for perceived value and results. Increasing competence is the surest way to increase the tribute one can charge the market. Freelancing allows testing real market value without intermediaries. Instead of selling hours to a single employer, one sells solutions to multiple clients. The transition from charging for time to charging for results eliminates the earnings ceiling. If a strategy generates high profit for the client, the provider can capture a larger slice of that value. Thinking like a business and not like an employee is the key to unlocking superior earnings. The claim of lacking talent does not hold in the information age. Digital skills, sales, or management can be learned quickly and cheaply. Knowledge is available. Ignorance is a voluntary choice. Learning a skill that pays a mere $1,000 extra a month and investing that amount can result in a millionaire fortune over 30 years. The effort of learning today is the investment with the highest possible return on human capital. Skepticism regarding financial market returns usually stems from a lack of historical perspective. The stock market, represented by the largest companies, has been a wealth-generating machine for over a century. Trying to outsmart the market is risky. Wisdom lies in allying with it. By buying the index, the investor puts the world's greatest corporate brains to work in their favor. It is a form of consented and profitable exploitation of the capitalist system. Fiscal efficiency is a critical component of the strategy. Using retirement accounts or tax-exempt investments is an essential defensive maneuver. The government will always seek its share of profits. It is up to the investor to use the law to minimize this capture. The difference in profitability between a taxed and an exempt investment over decades can represent the difference between wealth and mediocrity. Failing to protect wealth from unnecessary taxes is negligence. The barrier to entry for the investment world has been demolished by technology. The ability to buy fractional shares allows anyone, with any amount, to participate in the profits of large corporations. It is no longer an exclusive club for the elite. The democratization of access removes excuses for inaction. It is not necessary to be rich to start investing, but it is imperative to start investing to eventually become rich. The door is open. Investment automation is the tool that protects the individual from their own fallibility. Human will wavers, but systems are constant. Configuring automatic transfers to investments removes the decision from the emotional sphere and places it in the systemic sphere. Money is allocated before it can be spent. This discipline forced by technology ensures that the plan is executed regardless of the investor's mood or momentary temptations. Diversification acts as insurance against the uncertainty inherent in the future. Betting everything on a single card is imprudence, not courage. Using ETFs and funds that buy hundreds of companies at once dilutes the risk of ruin. If one company fails, the others sustain growth. Strategic intelligence understands that capital preservation is as important as its multiplication. Divide and conquer applies perfectly to asset allocation. Keeping money idle is allowing inflation to erode purchasing power. Even the emergency fund or short-term capital must be allocated in instruments that offer some return. The inefficiency of idle money is a luxury that those seeking wealth cannot afford. Every monetary unit must have a mission. Either it is guaranteeing security or it is conquering more territory through interest. Money without a function is a wasted resource. Market volatility is the price paid for superior returns. The astute investor is not swayed by the panic of drops nor the euphoria of highs. He maintains the charted course. Economic history shows that rational optimism is rewarded in the long run. While the masses sell low out of fear, the strategist buys at a discount. Emotional control in the face of chaos is what separates winners from losers in the financial market. Rigorous self-analysis is necessary. Is cash flow positive? Is passive income being built? Is automation active? If the answers are negative, the financial fortress is vulnerable. One should not wait for the crisis to arrive to fortify defenses. The time to correct the course is now, while there is still time and resources. Ignoring flaws in one's own financial management does not make them disappear. It only ensures they will cause maximum damage in the future. Expecting external salvation, whether from the government, family, or luck, is a failed strategy. The system is designed for the maintenance of the status quo, not for individual liberation. The responsibility for financial ascension is solitary and non-transferable. Accepting this reality is the first step to real power. By accepting that no one is coming to help, the individual mobilizes their own resources and ingenuity to build the exit. Autonomy is the prerequisite for freedom. The 20% rule for investments is the tax paid for one's own future freedom. If living on 80% of income seems impossible, the problem is not the income, but the inflated lifestyle. Wealth is relative to need. He who needs little to live and invests the rest is freer than he who earns millions and needs everything to pay bills. Widening the margin between earning and spending is the only way to create lasting sovereignty. Monotonous consistency beats sporadic intensity. Solid wealth is built brick by brick, month after month, in a process that may seem tedious. Those seeking excitement and quick shortcuts usually find fraud and losses. The wise investor learns to appreciate the boredom of slow and steady growth. It is silent and uninterrupted accumulation that builds mountains of money, not momentary explosions of luck. For extra income, scalability is the ultimate goal. Selling hours has an insurmountable physical limit. Selling products, knowledge, or digital systems allows income to detach from time worked. The search for leverage, doing more with less effort, is the essence of capitalist efficiency. Businesses that function while the owner sleeps are the supreme form of wealth generation. Intelligence seeks scale, not just hard work. Dividends represent concrete proof of the strategy's success. Receiving income without the need for active work validates the entire effort of accumulation. Initially, the values are symbolic, but systematic reinvestment creates a snowball effect. Interest on interest accelerates the process until passive income covers the cost of living. At this point, work becomes an option, not an obligation. This is the final victory. The most valuable and inalienable asset is the intellect. Investing in financial education protects against fraud and errors of judgment. The market punishes ignorance with financial losses and rewards knowledge with profit. Understanding how money works is more important than momentarily having money. Capital can be lost, but the ability to recover and multiply it remains in the trained mind. Continuous study is the best defense and the best attack. Skepticism is necessary armor against promises of easy enrichment. Offers that seem too good to be true are invariably traps for the greedy and naive. The path to real wealth is paved with patience and mathematics, not miracles. Protecting accumulated capital against charlatans and dubious schemes is as important as generating that capital. Unbridled greed blinds, cold prudence preserves. Geographic diversification protects against local systemic risks. It is not prudent to keep all patrimony tied to the economy of a single country. Investing globally allows capturing growth wherever it occurs and protects purchasing power against local currency devaluations. The modern investor must act as a citizen of the world, positioning resources where they are best treated and where they can grow with greater security and vigor. Investment monitoring must be periodic, not obsessive. Constant checking breeds anxiety and the urge to meddle with what should remain still. Long-term strategy assumes short-term turbulence. The investor must have the coldness to hold the position while the investment thesis is valid. Patience is a profitable virtue. Hyperactivity is a tax the investor pays to their own insecurity. Let time act. Management fees are parasites feeding on the future. A 1% or 2% difference in fees, compounded over decades, transfers a gigantic slice of the investor's wealth to the fund manager. Preference must be for passive, low-cost investment vehicles like ETFs. Cost efficiency is one of the few variables the investor can fully control. Minimizing operational expenses maximizes the final result. Financial legacy requires more than money, it requires culture. Transmitting fortunes to unprepared heirs guarantees the destruction of patrimony. Education on the value of work, risk management, and discipline must be part of the inheritance. A dynasty is maintained not only by full coffers, but by solid values passed from generation to generation. Preparing successors is the only way to ensure the empire survives the founder. Strategic minimalism focuses on essence and eliminates noise. Unbridled consumerism is a distraction keeping the masses poor and occupied. By rejecting the need for external validation through material goods, the individual frees up resources to buy freedom. True wealth is silent and discreet. The goal must be to possess the power of choice, not merely a collection of objects that require maintenance and generate worry. The size of the start is irrelevant compared to the importance of habit. Starting with little establishes the discipline needed to manage much. Inertia is broken by the first movement, however small. Waiting for ideal conditions is the excuse of those who never achieve anything. Immediate action, even if modest, alters the trajectory and places the individual on the path of accumulation. The act of investing shifts identity from consumer to capitalist. The stark reality is that everyone is the architect of their own ruin or ascension. The government is not a benevolent father, and the market has no feelings. Armed with knowledge, the individual ceases to be prey and becomes a capable competitor. Assuming total responsibility eliminates the victim mentality and empowers action. The tools exist. The will to use them is the determining factor. Strength comes from autonomy. As a classical strategist would observe, where the will is strong, difficulties diminish. If the desire for financial freedom is genuine, obstacles like low salary and debt will be treated as problems to be solved, not fatal destinies. Fortune favors the bold, but serves only the prepared. Knowledge transforms fear into a plan and uncertainty into calculation. The world clears a path for those who know where they are going. Postponing the start is assassinating the possibilities of the future. Tomorrow is the refuge of failures. Every day without investment is one day less of compound interest working in your favor. The sense of urgency must be constant. Treating financial independence as a vital emergency accelerates decision-making and execution. Time does not forgive hesitation. The time to act is invariably now. Delay costs dearly. Possession of information differentiates the elite from the masses. but only execution creates results. The world is full of poor theorists. The distance between the current situation and the million is filled by relentless action and daily discipline. The map has been delivered, traps exposed, and the path illuminated. Now it is up to the individual to walk. Unapplied knowledge is a buried treasure that will never be enjoyed. Wealth is accessible regardless of the starting point if there is a method. Follow the strategy, keep a cool head, and time will be your ally. Do not let this knowledge dissipate. Transport this plan to reality. If you wish to continue receiving coordinates for this conquest and sharpen your strategic mind, subscribe and join those who build empires. Ascension is inevitable for those who do not give up. See you at the top.